Welcome to The Explainer. Today, we're tearing into Tesla's Q2 2026 earnings call, and we're looking at this strictly from an investor's perspective. If you've been tracking the numbers, you already know this quarter wasn't just another routine update on vehicle deliveries. No. What we're looking at here is a massive, structural capital allocation pivot. All right, let's just dive right in and unpack what management is actually betting the farm on.
To set the stage, Elon Musk laid out a pretty bold claim, calling their current strategy the most ambitious build-out of advanced infrastructure manufacturing capacity ever in history. Now, if you're deploying capital, a sentence like that should immediately ring some alarm bells, either in a really good way or a terrifying way, depending on your risk tolerance. But it completely frames our whole conversation today. Tesla is aggressively shifting massive amounts of capital away from standard auto manufacturing and funneling it directly into next-generation AI and infrastructure.
To navigate the absolute mountain of tech updates from this call, we're going to use 5 strategic pillars. First, core auto and financials. Second, the massive CapEx cycle. Third, FSD and robotaxi scaling. Fourth, Optimus, a supply chain zero. And fifth, energy, AI, and synergies.
All right, Section 1, core auto and financials, the current engine.
Before we can really look at the future, we have to establish the current financial engine that's paying for all of this. And what's really catching my eye here is this staggering number, 55%. According to CFO Vaibhav Taneja, in North America, roughly 55% of Q2 deliveries had a full self-driving subscription attached, right at the time of delivery. Elon pointed out that customers are practically walking into stores to buy FSD, and it just happens to come with a car attached. For us investors, this points to a fundamental shift in buyer behavior. FSD is no longer just a fun add-on. It's literally becoming the primary demand driver.
And that brings us to the recurring revenue potential. Out of the 1.5 million FSD users globally, we've got a 55 to 45% split between upfront cash purchases and ongoing monthly subscriptions. Management actually expects the bulk of future FSD monetization to come strictly from the subscription side, especially since they've already yanked the upfront purchase option in most markets. Basically, Tesla is successfully layering a highly predictable software-as-a-service style revenue stream right on top of its hardware base. Okay, but we do have to address the elephant in the room, which is the immediate friction point: margins. Automotive gross margins, excluding regulatory credits, dropped sequentially down to 16.3%. Now, if you're a standard automotive analyst, this is the exact moment you start sweating. But management was actually quick to provide some vital context here. High interest rates pushed up subvention costs, which is a direct hit to revenue. Plus, remember Q1? Q1 had a $230 million benefit from warranty true-ups and tariff relief that obviously didn't repeat in Q2. So the really crucial takeaway is that when you strip out those one-time benefits, core pricing and cost management actually held pretty steady. The legacy auto engine is stable, which is absolutely vital because of what we are looking at next.
Section 2, the massive CapEx cycle, funding the next S-curve.
We are pivoting sharply away from present-day margin preservation and zooming in on the massive investment cycle Tesla is triggering right this second. Consider this staggering figure. Over $25 billion, that is the expected capital expenditure for this year alone. They essentially doubled CapEx sequentially in Q2, and they are fully expecting it to climb even higher in the back half of the year. Management didn't mince words here. They are in a massive investment cycle. Whether it's expanding the Robotaxi fleet, building Optimus production capacity, standing up a new semiconductor fab, or scaling AI compute, they are prioritizing the sheer speed of deployment. They want to maximize net present value over any short-term capital efficiency metrics.
To actually fund all of this, Tesla is making the deliberate choice to expand its debt facilities up to $30 billion. They want the dry powder to opportunistically accelerate these investments. And from a capital structure standpoint, taking on debt when your balance sheet is already incredibly cash-rich, that shows immense conviction. They genuinely believe that securing productive assets, things like custom silicon fabs and massive compute clusters, will yield, as Elon put it, the best CapEx returns they have ever seen.
Moving on to Section 3, FSD and robotaxi scaling, the autonomous fleet.
Let's see exactly how that capital is being deployed to build out this autonomous network. To really grasp their strategy, you've got to understand the mental model management is operating under. They call it the March of Nines. It's basically the grueling process of pushing reliability to 99.9999% before they even think about broad deployment. Why so extreme? Because look,
While tens of thousands of human-caused automotive deaths tragically go unreported in the daily press, even one single injury caused by a robotaxi would trigger massive global headlines and an immediate regulatory crackdown. Their ultimate constraint right now is not demand. It's proving absolute zero-harm safety for humans and pets to keep regulators on their side.
And the early data is incredibly validating. VP of AI Ashok Elaswamy shared some truly wild metrics. Over 380,000 completely unsupervised miles driven across cities in 2 states, with 0 notable incidents. But what's even more compelling for us as investors is the growth rate. Unsupervised miles are compounding at a double-digit rate. We're talking over 10% week over week. It's serious proof that safe, affordable autonomy can be achieved purely with cameras and AI, entirely validating their controversial decision to avoid expensive LiDAR systems.
Section 4. Optimus, a supply chain zero.
Now we shift focus to their second massive, high-risk bet, the Optimus humanoid robot. The true manufacturing risk of Optimus becomes glaringly obvious when we look at the supply chain. You see, when Tesla scaled the Model 3, they could lean on a 100-year-old, totally mature auto supply chain for things like wheels, glass, and body panels. But with Optimus, it's literally a supply chain zero. There are 0 existing suppliers for robotic human dexterity. Because of this extreme newness, Elon explicitly warned investors to calibrate their expectations. The initial manufacturing S-curve for Optimus is going to be very long and very flat, simply because they are forced to build this complex supply chain entirely in-house.
So, with all that hardware complexity, how does the robot actually learn to do things? Ashok walked through this fascinating 3-step flywheel. First, you've got human factory demonstrations, where they literally use their own factory workers to provide high-quality movement data. Next is what they call the Optimus Academy, where the bots practice these tasks to close the form factor gaps between human bodies and robot bodies. Finally, reinforcement learning kicks in. The bot attempts the tasks, inevitably fails a few times, and learns to master them autonomously. It is the exact same pixels in, controls out AI architecture used in their cars, just applied directly to humanoid robotics.
But honestly, absolutely none of this works without custom silicon. Taking a look at their AI hardware roadmap, we're currently on AI 4. By mid-next year, they expect AI 5 to hit volume production, and that's going initially straight into Optimus. And get this, they are already designing AI 6, which Elon genuinely believes will be the best edge computing chip in the world. This whole roadmap completely relies on the massive new development fab down in Austin, which brings lithography, logic, memory, and packaging all under one giant roof. That level of vertical integration allows for incredibly fast iteration cycles.
And finally, Section 5, Energy, AI, and Synergies, the infrastructure web. This is where we start seeing how these wildly different bets lock together perfectly. Energy deployment saw a massive spike, hitting 13.5 gigawatt-hours in Q2. That is a 53% sequential increase. Now, yes, energy gross margins took a temporary hit, dropping down to 20.4% due to some legacy true-ups. But management fully expects that to normalize in the low to mid-20s. But here's the real question. Why is this so critical to the AI story? It's because AI data center training runs require massive amounts of power, and that power fluctuates violently. Megapacks act as the critical advanced power electronics needed to smooth out these massive power cycles for hyperscalers. The current AI boom literally requires Tesla's energy business to function.
And the flywheel just doesn't stop there. We are seeing some incredibly powerful synergies developing between Tesla and SpaceX. Think about it. You have Grok acting as the overarching manager for Digital Optimus, which is the AI operating standard computer screens. You have SpaceX directly buying Tesla Megapacks for their own massive compute data centers, and critically, you have Starlink integrating directly into the Cybercap fleet. This guarantees that robotaxis never get stranded in cellular dead zones or communication Bermuda triangles. It massively lowers operational risk while also providing high-bandwidth entertainment for passengers.
So, we finally arrive at the ultimate question for you, the focused investor. With over $25 billion being deployed this year alone to fund next-generation custom chips, autonomous fleets, grid-scale energy storage, and humanoid robotics, is it really still accurate to value Tesla as just a car company? Or are we actually watching the rapid evolution of the world's most ambitious AI and robotics infrastructure fund? It's a massive paradigm shift, and it's something you seriously need to consider as you update your models. Thanks so much for joining me for this explainer, and as always, keep questioning the data.